Question 2 is from part B, and it says, refer to the information contained under the following heading, Mercury Pty Limited. Calculate the total dividends tax and the net cash amount available for distribution to the shareholders as a consequence of the liquidation process. And you are required to show all your calculations. Now, the first thing I want you to see here is I did not give you a format to use, so you could, in theory, use any format. What sometimes happens is, quite often in the questions they give you a format to use, you should use that then, but I wanted you guys to basically just use your own brain, your own thought process, and do this. Now, when we do a liquidation, it's important that you remember that what we're going to do is, and let me actually start it here. We are going to do a calculation of reserves or of equity. In particular, what we want to do is we want to look at our, so you get, there's two reserves. There's not subject to dividends tax, and the only one of that is contributed tax capital, and then we have subject to dividends tax. And those are the other reserves. For example, retained earnings. Now, what you need to do is you basically need to calculate the closing balance for it. So remember, we're going to do the following. We're going to say opening balance plus accounting profit less tax liabilities equals closing balance. And if you think about it, that's really what usually goes into retained earnings. And that's what we're going to be doing there. So we're literally going to start, I'm literally going to recommend that we do it in the same way. The most common way is to use it or to calculate using equity, or the equity method instead of the asset method. Remember, assets equal, or equity equals assets less liabilities, so you could use assets less liabilities as well if you want. Okay, so it's literally the same thing again. Opening balance accounting profit or loss taxes. Okay, so the opening balance, let's start with calculation number 1. Sometimes I give it to you. In this case, we didn't. I gave you assets, I gave you liabilities. So this over here, this will be our calculation 1. I'm not going to rewrite it, but just to take you through it again quickly. Equity equals assets less liabilities. So assets 957, liabilities 172. The difference between those two is equity of 785. So that's all of your equity, capital, retained earnings, all of those things. The contributed tax capital is 100,000 shares at 1 rand per share. It's 100,000 rands. So 685,000 is the other earnings. So the opening balance here will be 100,000 for contributed tax capital and 685. So in total, the 785, as you can see. Now, let's do our accounting profit or loss. Okay, so what are we going to do for accounting, guys? We now basically just have to go and we have to account for it. So this is profit and loss, everything that goes through profit and loss. Now the VAT deregistration is not going to go through profit and loss. Those things are all sitting in some form or another in our balance sheet, statement of financial position, because it relates to VAT. Okay, there is this 15% bad debts deduction. That is something that we will have to show. Okay, so, but what I recommend we do is let's go through it. So let's start here. So the first thing here we can see is that there was trading stock that was sold at cost. Now the cost of the trading stock, remember this includes VAT, so that's not correct. But if you say 166,750 times 100 over 115, it will give you this 145,000 there. Okay, so they're basically saying, let's do it like this, trading stock. And I know this is not IFRS compliant or anything like that, but that's fine. We're not doing it, we're doing tax here. But accounting still applies. This must be equal to cost. What happens when you've got sales? You've got cost of sales. And what was the cost of the sale? The cost. Right, let's go back. Let's go through it. Right, then there's the debts collected. So here's that bad debt of 15%. The trade and other receivables over there, the 227 guys, that is an amount including VAT, of course. And we can't claim the amount including VAT, so 227 times 100 over 115. Sorry, times the 15%, 29609. Right, so we're just doing basic bookkeeping here, almost. Then we've got the liquidation cost, 250,000. Okay, then the liability settled and the distribution to the shareholders. Do we account for that in profit and loss? No. If you think about the liability, let's say we owe this money that we owed SARS here. Right, all these 52,000 here. How would you pay for it? You say debit the liability, credit bank. It doesn't go through profit and loss. Obviously, you guys all know that. I'm just making sure. So this gives us an accounting loss. Right, so this goes into our reserves, 279,609. Now we have our taxes. Now the first tax that I want to do is this output VAT over here. Because this will now be an additional expense for us, a tax expense for us that we have to raise. Right, so for the tax, let's call this calculation number 3. Okay, so calculation number 3 now will be the VAT. So section 8.2, deemed supply as ceasing to be a vendor. We're going to use these headings: description, calculation, explanation, and let's do it rands, and I'm going to say here output tax, and well, let's make output tax negative and input tax positive. Okay. So it's calculated on the lower of cost, including VAT, or open market value. Remember the term open market value, as they give it to us here, is an amount including VAT. It is defined in the VAT Act itself, so it's a term that you have to be aware of if they use it. Open market value. Okay, so cash and cash equivalents, trade and other receivables, trading stock, and trade and other payables. So the first one is cash plus equivalents. I'm just going to call it that. Do we have any VAT on that? There's no VAT implications on cash and cash equivalents. We then have the trade debtors, right, the debtors, and there's the output tax on that was already accounted for. Why? Because we calculate output tax on the earlier of invoice or payment, and if we have it recognized, it means we've received an invoice. So that's the invoice amount. But what do we have here? We have also, and we know in the bad debt process, section 22, we've got a bad debt here. And the bad debt is the trade debtors 227, that's an amount including VAT. So times 15 over 115 gets us the VAT, and 15% of that was bad. So that's 441. Input tax, guys. Then we have our trading stock. So we're calculating the output tax on the lower of cost, 166,750, or open market value, 189. So 166,750. Okay, and then trade payables. Now remember, the whole idea here is that the trade payables is when you received an invoice there for the trade payables, you'll reclaim the input tax. But now, by the time you pay it, you're no longer going to be a vendor. So SARS wants to make sure that we're not trying to manipulate anything, so we have to calculate it on our trade payables. Right, sorry, and both of these I've calculated were output tax, so I'm putting it in brackets. So it's 24,091 total due to SARS. That will decrease our available cash balances. So 24091. Then we have what is our next type of tax, and this is the one where you should have also scored all of your marks, guys. The one we all know, income tax. Okay, so we're going to do the same. Let's start from the top. So what do we know? Everything that happened for income tax purposes. The first thing that we know is we've had some trading stock. So there'll be opening stock, low of cost or market value, but it's basically what last year's deduction amount was for and closing stock, so the cost usually, and then it was sold at cost. So now here's a sale. So I want to break that into two parts. The actual selling price, which was 145. And then section 22.8 tells us that if you sell something to someone as less than its arm's length, you need to include the market value, right? Less what you've already included over there. Now, in this case, the market value of the trading stock was 189, and that's including VAT, which you obviously have to include or exclude. 189 times 100 over 115, that will exclude the VAT for us. And from that, we then deduct the 145,000 has already been included. So that gives us 19,348. So basically, this total here is the same as if we sold it at its open market value times 100 over 115, the total there. Okay. Then next is the dates collected, so we have that bad date. Section 11I. 227. Remember the rules for bad debts. You can only include the amounts or claim a deduction for amounts that were taxed at some point, and we would have been taxed always on the amount excluding that. Okay. Then the liquidation cost of 250,000. And we have a comment here. Remember, we can't claim a deduction for it because it's not in the production of income. And that is correct. Liquidation costs. No deduction under section 11A as not in the production of income. And that's it. If we add up everything here, we'll have 10,261 as an assessed loss. So the tax liability at 28% on an assessed loss is null. You don't pay tax on a loss. This should be carried forward to next year, but there will be no next year because, as we know, this company is being liquidated. And then the last one here, and guys, this is a tricky one. Not a tricky one, but students often forget it. Dividends tax on dividends in specie must be deducted over a year. And why? Because the company is liable for dividends tax. So that decreases our for dividends tax. That decreases our reserves. So that's why it's included here. That's important. Okay, now in this case, I'm not going to go and write it all out, but let's just quickly talk about it. What are dividends tax? Right, so the dividends that you can argue here is the distribution of those shares, or of those trading stock, that market value there, because of the fact that they've given it at some premium there. However, this is a distribution to a company. And as it's a distribution to a company, South African company, there's no dividend tax on it. Right, so it won't affect us there. But I just wanted you to be aware of it. I actually mostly included it here just as a reminder for you of where that would all fit in. Okay, so then we can add up everything here. Now, this is not subject to dividends tax, and this is subject to dividends tax. Remember, the question asks us they're required to calculate the dividends tax, right, which is an amount we're going to then deduct here, and that will give us the net cash amount. Now, the net cash amount for contributed tax capital we can already include. We have to go and calculate the dividends tax. So we'll call this calculation number 5 for me now, right? But I'm just going to call it calculation 6. That's the same as in your solution. but let's just quickly do it. Right, so the dividend amount, I just want to make sure everybody's in the same picture, is this 381,300. Now you can do whatever layout you want here, but I'm just going to do as quick as possible. There's Nutter, Farsight, and the Biggles Trust. For Nutter, there's no dividends tax because it's a South African company, section 64F1A. Please remember that, so no dividends tax. Farsight is not a South African company. It is a foreign company. So I just want to quickly go and get the shareholding percentages here, 15 and then 40. So 381,300 times 15% times 20%. And the Biggles Trust, 381,300 times 40% times 20%. Gives us 41943. That 41943 gets deducted. And it gives us 339,357. So the sum of these two together, 439,357, that is the total amount of cash that the shareholders will receive. Right, each of them will obviously get their own share. Okay, and we'll continue with question 3 just in our next video.